nervy, unprecedented time period in human history. And so I had a client rang me last week, as an example, in a bit of a panic because he'd read something about what was going on in the markets and the stock markets and the currency markets, and he was in a blind panic because he's got relatively significant wealth. He's got multiple seven figures liquid, and he was panicked about where to put it. And I think if you don't pay attention to the global trends, sometimes we operate in a microcosm and we dismiss the external factors that have a significant play. So if you want to flick to the relevant page in your workbook, if you printed it out, or in the PDF, this is on page number 10. Page number 10, that's the page that we're going to be working from. And there are 3 trends that I feel that any business owner right now needs to be paying attention to and adapting accordingly. The right strategy, Mike, at the wrong time is the wrong strategy. So Lee, if you've got a brilliant idea, but you execute it at the wrong time, you will get your backside handed to you. And I think there are 3 notable things which you resist them, Rob, at your peril. So what are they? So the first, trend number 1, which you must adapt to, is the rise of tech. Now, again, Dan, you're stating the obvious, but I want to reiterate, just if you look at the businesses, Alistair, that have really struggled in the last 12 months, it is often the ones who have failed to adapt their business model and to be able to take the bits online that they were able to take online. So if the rise in tech is coming, what that means is there's more global competition than ever before. And if you do not technologically adapt, Sonia, you become if you're a Luddite, your business is significantly going to suffer. But the real question, Paul, is how do you adapt to this trend? Right? How do you adapt to the trend of the rise in tech? And I think there's 2 answers. And this is really at a principle level. I'm not going to go into specific platforms, Jody, that you need to be on top of, or particular bits of software that you should be using, Alex. I think there are 2 things that you need to do. Number 1, I think you need to improve. I think burying your head in the sand is not an acceptable defense. And if you do not grow technologically quicker than the market, you will net be falling behind. And that will hurt you. That will hurt you, Mike, over time. But the second point that I want to make, Jody, is perhaps even more important. The disadvantage we all have as small business owners is we are nowhere near as capitalized as the big tech companies. Now, yes, we can often utilize a lot of the technology that they make available to us, but we don't have the funds. So how do you balance that equation? And I think in a world that's becoming increasingly tech-led, it leaves often an underweighting to emotional loyalty. Emotional loyalty, which is often derived via customer experience. Right, so a great book on this topic, if you want to entertain yourself, Lisa, is called The Revenge of Analog. Ian, you like that book. It's called The Revenge of Analog. And it's about how customers are craving more and more that personal touch, that personal connection. And that's exactly where I feel that most small business owners can excel. One of my biggest pet peeves, Ollie, is for when businesses systemize, and they fall in love with the process, which hurts them. Because what I think they should be doing, Laura, is falling in love with the customer. Right? I've got this process. And every single person on this call, I'm going to say, Paul, Kev, in the last, definitely 30 days, but probably in the last week, has been hacked off at some system, some process, some giant entity where we didn't fall neatly inside the boxes, and therefore we couldn't log in, we couldn't reset the password, or we didn't get the correct answer, or we couldn't get the data that we want because we didn't fall into their methodical system. So I think the advantage is in creating real emotional loyalty. And I would obsess, Rob, if I was in your shoes. How do we create closer emotional loyalty to with our clients? How do we create a much better customer experience? I strongly feel that it's significantly underweighted and it pays dividends. It's just the real numbers freaks amongst us hate it because it's not always the easiest thing to measure. So that is the first trend. The first trend is the rise of tech. And I'm less bothered, Gav, with what's going on now, Tamazin, than where it's going. Right? It's like, what do you see as future trends that are coming as it relates to tech? What is coming? What is downstream? A few years ago, I made an awful lot of money in multivariant testing of websites. And it was, and I was involved with a software company that was a paid bit of software that was very expensive that allowed you to do all this testing. And then one day, Google launched a free split testing, multivariant testing tool, and it wiped out an entire industry because of failure to anticipate a technological trend in the market. So the question, before I ask Andy to put you into breakout rooms, just for a quick 10-minute chat in your breakout groups about what technological changes are coming that could change everything and how you're going to adapt to it. Okay, and I'm good with that at a strategic level. It could be an AI or a robotics type conversation, and I'm also good with that at a tactical level. Right, there are one or two of you that are still refuse to go on cloud-based servers, which blows my mind. I was talking to a business owner last week that still, Ian, had their Sage accounting software, and it shows you the fact that they're on Sage and refused to move, but it was desktop bound to the desktop in their office. Right, that they couldn't give me access other than kind of showing me virtually via sharing screen in Zoom. And look, these things are going to hurt. So whether it's tactical or strategic, I don't mind. But Andy, put me into breakout rooms. I want you to talk about trend number one, the rise of tech. How are you going to adapt to it? I want you to think it through from a learning new tech and also from a customer experience perspective. Any questions before you go into breakout rooms? All right, Andy, break out us away. I'm not sure that's a logical sentence, but we'll go for it. Okay, welcome back, everybody. Welcome back. So I'd love to get a few samples, whether it's Eliza or Lisa or Kev, who would like to share. In fact, I'll share a quote from Gav in the chat. The biggest mistake that companies make who I work with is that they put process before people, create an emotional connection with customers, and they will stay loyal, spend more money, and recommend you. I think that's very true. Gav. So who would like to share what questions came up for you, or what thoughts did you have on the rise of technology? Yeah, go for it, Laura.
We ended up having an interesting chat about direct mail, which is a way, I think, to kind of combine some of the stuff you're talking about with a more personal touch with using tech and something systematized. I work in software where no one ever sends physical mail out. So it's kind of interesting that if you're in an industry like that has less physical mail, you can actually be really innovative and really stand out by sending something in the mail. So that gave me a little to do of just collecting mailing addresses, because right now we actually don't have mailing addresses for our customers.
Yeah, I absolutely love that. I mean, just to doubly underline that, I mean, if Google are still to this day doing direct mail and sending out the little cards, for £10 vouchers for AdWords. There's a reason why they do that, and I do think it does worry me, the eradication of not eradication, that's too strong a word, the reduction in attention span. It's kind of being whittled away, and that's the beauty of putting something physical in their hands as a cost, but the chances of it being read and consumed are significantly higher than a good old-fashioned than just sticking to email, right? Or any online media, probably. So I like that a lot. Thanks, Laura. Very good. Anybody else like to share? What are you doing? What are your thoughts on tech, or how are you going to adapt customer experience? Laura spoke about the use of direct mail, which I'm hugely in favor of. In fact, I'd go as far as to say the more difficult and cumbersome it is, the higher the likely return on investment would be, because the competition won't be willing to do it. So that's something worth thinking about. So who else would like to share?
I might have a thing or two to say about online customer experiences. I've been sorry.
I'll let you say one thing. I'll let you say one thing, Lisa.
Oh, it's such a killjoy. So I've been dealing with an ill child, so I've been kind of slightly dipping in and out. So apologies to Group 6, where I've not been 100% present. And this has impacted our business massively, is it's bringing focus to the customer experience. I don't think before COVID, there was a lot of people really focusing on the customer journey and what the touch points are. And as a result of having to use technology more in our business, some more than others, of having to go, okay, well, what are the touch points? What are the customer experiences? And how can I enhance that whilst I'm not able to be face to face with people? Has been absolutely massive in my world over the last mostly the last 6 months, as everyone went, what, another lockdown? And had to not go back into the world. And that's now bleeding out also into, I know, the more bricks and mortar and face-to-face businesses, as they're starting to come back online as well, of bringing the knowledge that they've learned from having to create an online customer experience, an online customer journey, into how they can enhance that and make it better in the real world.
I like that a lot. And obviously, Lisa, a shameless plug is appropriate for the early May Skills Day, where you and I will be talking about a lot of things related to marketing, but the customer experience will be an integral part of that. So
customer journey will be the customer journey is the spine that runs through every single business, whether you're info, e-com, in-person, bricks and mortar, whatever it is. Customer journey is essential for everybody, and customer experience is completely aligned with customer journey. And I hear that Gav cheering me on with that.
Very good. Thanks, Lisa.
Yeah.
Also, Gav, I'll let you jump in. Just give a heads up to Andy. The SMM March, the host laptop is unmuted, just so you're aware. Go for it, Gav.
Yeah, I mean, just a few things. When you think about some of the businesses that have managed to succeed through this whole period of lockdown, it's largely because of the relationships they have with their existing customers, and the fact that those existing customers want to make sure they help them out. And so when these customers come back or new customers come in, relationships are key. And so whether it's a tech solution or it's an old school solution, whatever the solution might be, it's got to address what their problem is. And so for me, that's the focus that I've certainly got. Is it a hybrid approach? Is it a face-to-face approach? Is it more of a technical approach that they need? But ultimately, is it going to address the problem that they've got? And I think relationships are key. The emotional connection with your customers, when we do come back to the normal world, is going to help to make sure they stay loyal, spend more money, and recommend you to their family and friends.
Yeah, I like that. Well said, Gav. And for those of you that have never read, I'm a fan of Warren Buffett. Well, the Berkshire Hathaway letters to shareholders are always fascinating reading. He'll often talk a lot on this topic. But also, recently I've been reading the Jeff Bezos Amazon letters to shareholders from the beginning. And Jeff was always very upfront from day one that his goal was to become the world's #1 most customer-centric company. And I'm not sure whether or not he's succeeded in that, but if that's been his focus, certainly as a byproduct, he's created the world's most valuable company. So I think there's something to learn there. So let's jump ahead to trend number 2. So trend number 2, Thumbs up if you can see my screens, see the PDF. Okay, all good. So trend number 2, which I think hasn't even really started yet, but is about to, are attacks on the rich. Attacks on the rich. So obviously we just had the budget, and Ian Morgan, MES, our resident accountants, I'm sure he'll give you his opinions if you're in his breakout group. But we just had the Chancellor's budget. There wasn't the expected tax hikes, especially to kind of capital gains, which was suggested not that long ago that should be brought in line with income tax. And in fact, you could say it's a generous budget, but the fact remains that beyond record-breaking borrowing, record-breaking deficit, etc., somebody's going to have to pay for that. And who do we think that someone is? I'll give you a clue. Some of those people everybody on this call represents in that category, right? So as a reminder, I forget the exact percentage, but more than 50% of the adults in the UK pay no net income tax. So their tax credits, etc., outweigh what they pay, so they don't net contribute. So congratulations. I think if you earn more than it's something like £80,000 a year, you're in the top 5% of income earners in the UK. So yeah, we are the ones that are going to be paying for the pandemic. So to a certain degree, I don't begrudge paying my taxes, but I do think we need to be efficient, because I'll speak more to this later, but the rich-poor divide is only going to get bigger, and therefore there's going to be increasing pressure. I don't think we've even begun to see the financial fallout from this yet, and the impact on the knock-on effect into businesses. And so governments worldwide, but in the UK, no exception, are going to be increasing tax rates. Taxes are only going to go one way. So what does that mean? What does that mean, and how do you adapt to that? I think your only two antidotes are to educate yourself and to plan better. Have really give due consideration to long-term wealth planning. As an example, on the education side, I spoke to a business owner last week who was considering joining Mastermind. And he will, but he's not joined yet, so I won't mention his name. But he has a very high margin business, multi 7-figure turnover, high 6, low 7 figures profit. Ian, and check this out, Ian, ready? He had no pension contributions whatsoever, never saved anything into an ISA. There was literally no tax planning of any description. So I'm not a tax advisor. In fact, my intent might be to get a professional advisor, perhaps maybe even in the next Success Mastermind meeting. But so don't take anything I'm about to say as advice, just really to perhaps stimulate some ideas to go and ask your accountant or tax professional about. But as an example, in the UK, you can, as in a company, you can contribute up to £40,000 a year to your pension pot. That pension contribution that you can make as a company director, Rob, is counts as an expense. So you put £40,000 into a pension pot, and it goes as an expense. So it reduces your corporation tax liability. Think of, and that pension pot is then invested and gets to grow tax free, and you only pay tax when you take from that later. And there's lots of rules about pensions, which we're not going to talk about now, but that money can grow at a compounded rate, right? And yet the counter is what this business owner was doing, Georgia, was he was paying the corporation tax and then dividending out the money. So he was paying 19% corporation tax, and he was in the upper bracket for dividends, Ian. So he was paying 38% dividend tax. So he was getting taxed at the equivalent of 57% tax rate. And then he had the 43% left over, Arthur, and then he was investing that money. That makes no kind of sense to me whatsoever. Now, I'm not saying that you all should be contributing to your pensions albeit you should do. But the point is, you do need to get educated. You do need to get educated, and you do need to start planning about these things. And this business owner was just kind of, oh, well, I didn't know, hadn't sought out. And as tax rates go up, as I believe they will do, the advantages for things like pensions or other tax breaks become more magnified as the impact, Alistair, that it will have on your net wealth. So you have to get your ship in order, guys. Get your ship in order. Just to be beyond explicit, Sarah, I'm not suggesting you do anything underhanded or offshore, etc., etc. I don't think you need to be complicated. I think it's just the fundamentals. The fundamentals. Get several opinions. Don't just go with the first person that tells you some story that sounds too good to be true. Get your ship in order and start planning for building wealth. Okay. In fact, I'm going to talk more about that a little bit later on. So the trend number 2 is a tax on the rich. So I think you need to prepare yourself for how you are going to protect your assets and protect your wealth. So with that said, I'll off out into breakout rooms, please, Andy. I want you to give some consideration to what you're doing. Oh, thank you, Ian. Ian's posted. If you're happy, Dan, I have a video that Keith sent. Or actually, he sent it to me as a direct message. So I'll read that, Ian, before I announce it, actually, if that's okay. So, Andy, if you could put us into breakout rooms, that would be great. Okay, hello, welcome back. Welcome back. Anybody got any shares, thoughts, comments, or questions about that point?
I'll chat.
Perfect, Jody.
So I went into that group and immediately cursed because I was just like, fuck. Just that was me. That's me, basically. And we just had a really good conversation, and I've already been recommended some IFAs, and because I haven't paid into a pension since leaving the corporate world. And yeah, it's so bleeding obvious, but you don't know what you don't know, and I've grown up in not in a business world. I'm the daughter of artists. So they were not teaching me about where to put your money because it didn't have any money. Anyway, I feel like I've just been slapped in the face, but rather find out now than in another 10 years' time.
Yeah, good. So good that you've been slapped in the face.
Yes.
Against me, I'm not sure that's the...
Metaphorical.
That slap in the face is going to save me money. But it is metaphorical, but it actually, I feel the pain. I feel the pain of having not been... I ask my accountant constantly about tax efficiencies. I've gone to them saying I've heard about this R&D tax relief, and I don't get the proactive. I don't expect the proactivity, but I can't know everything about everything, right? But I also want good people around me to be able to go, hey, have you thought about this? Why aren't you doing this? It's so bleeding obvious. I didn't know. It's like it's seen as an expense and is offset against your corporation tax. That's one sentence. You don't need to convince me any bloody further than that. Why in 10 years have I never heard this? Anyway, as you can tell, I'm very
Well, Jody,
passionate about.
this is good news, right? As in, for everybody here, this is why you're here, not specifically, obviously, about tax advice, but that's the beauty of being in a room of business owners, of masterminding, connecting, and sharing. Because again, you definitely need to get it right. And by the way, Ian direct messaged me saying he's got a short, it's a 2-minute video, which I'll get you to share, Ian, but give us a moment. I don't want everyone to be distracted during the session. So I'd say at the end of the session, post it in the group, Ian, and it's a good little checklist. I watched it when you guys were in breakout rooms, and yeah, I really like that video, Ian. In fact, it's a good job, good little lead magnet. So yeah, post it in the group and just have a watch, and it just gives you some. Again, it's not the advice. It really just gives you almost a little checklist to go and bounce off your advisor. But Jody, I say this normally to new members, and Jody's obviously, everybody here, if you were here at the start, know that Jody's just joined us. It's fairly common. I don't know what the rate is, but it's 1 in 3, 1 in 2 people that join the group end up switching out their accountant and or bookkeeper after joining the program, because they realize they're not fit for purpose. I'm not saying that yours isn't, I don't know, but because sometimes it's the business owner that needs to get educated, and even if you've got a really great accountant, ultimately it hurts your pocket. So there's no substitute for just taking ownership, being in groups like this, and knowing what questions to go and ask. So yeah.
Thank you for that slap in the face.
What's the is it Japanese proverb? The best time to plant a tree was 20 years ago. The second best time is today. I feel that's probably apt as it comes to wealth planning for the long term. Very good. Any other comments?
I might have something to say. Go on.
Yep. Oh, you again. Hello, Lisa.
Well, I don't have to, Alistair. I mean, why don't you go, Alistair? Because it's interesting. You go first, and then I'm going to jump in.
Right, because I'm near a pension age than you, just.
Pretty much, yeah.
Dan, a couple of things. I actually took this one as a tax on the rich, as in what do we all do about it? So wealth, educate, planning, pensions, etc., and all very valid, and we all agreed that. The other I looked at was actually attack on the rich, and what does that do to all our businesses? Because we're all part of our pension potentially is the value that we're building in our business, and that's foremost what we got to protect. So for me, quite a number of my customers are rich. So if they're not going to have so much value, I have to be careful about protecting them. So we try to widen our offer, widen our market, make sure we can get people slightly more affordable offering. So just keep an eye on, don't expect the rich to come paying in the years to come as they have been in the past. Maybe so just keep an eye on that side of it as well.
Yeah, great point, Alistair. In fact, you kind of just beginning to tease ahead of trend number 3, which I'm going to get to. So yeah, good. I agree with everything you just said. Go for it. So thank you, Alistair. Go for it, Lisa.
So there was a couple of points here, and it was like, okay, if I am cash, am I paying down debt in order that I can then have the assets for later? Am I investing in an ISA at a post-tax income? And I've just hoped that Ian is nodding ferociously at me right now. Or am I putting into a pension at a pre-tax income with a view of what's going to happen later? But then a nice little curveball was in there, because I'm in a group with Oliver, because my business partner is 20 years younger than me. So his planning is going to be very different from my planning. So, what I'm doing, which is going to be slightly less risk averse and trying to get myself more towards financially free, for him, 20 years younger than me, is going to be maybe slightly higher risk because he's got more time and is going to be earning money beyond the time at which I want to start working. So it was just interesting to go, and that's what I said about Alistair going first, because Alistair is another 20 years on me. So it's interesting, the different strategies.
Order.
You are 20 years older than me.
I was going to say, Lisa, should you be in business with a 12-year-old?
Oh, Jacqueline, I love you. Just as far as just looping back to the actual point, but I'll take that, is the strategy also depends on where you're at in your, not just where you are with your wealth and with your business, but where you're at in your life as well. That's what I had to say.
Yeah, spot on, Lisa. Spot on. And well, perfect. It's a perfect segue. So I'm going to jump straight into trend number 3. So trend number 3, thumbs up. You can all see the PDF. So, yep, good. So trend number 3 is, as I see it, is mass liquidity. Mass liquidity. So the printing of money. I mean, I remember when quantitative easing and the last recession came in, and everyone was like, "That is an astronomical amount of money." And I'll be misquoting, so I'm not going to quote the amounts of money that were at play then versus now. But all I know is that it so radically pales in comparison. It's a bit like the trend a year ago of the cases of COVID versus the trend in like January. It's just an order of magnitude larger. The whatever it is, 1.7 trillion US bill that was recently approved, you know, the 800 billion that Rishi has thrown in from a UK perspective, it is eye-watering. And by the way, this can be seen across Mastermind. For those of you then private masterminds, generally speaking, across all the groups, there's more cash in all the businesses than ever before. On the one hand, I'd go, this group is not normal, in that the results and the returns on investment and the profit and the growth rates that have been achieved far exceed the general marketplace. But that only tells part of the story, because an awful lot of people have gone and got bounce backs or C-bills loans, right? And by the way, Laura, that speaks to the point of the right strategy. It's got to be the right time, because people that have known me, Kev, for any length of time know that I'm massively personally anti-debt, abhor debt. I'm very conservative from that perspective. So I've never, ever gave anybody any advice to go and borrow money basically to solve a problem in 10 plus years of masterminding before 12 months ago. As soon as Rishi comes out with the C-bills and bounce backs, I'm going, good gracious, as long as you're sensible with it, almost go and borrow all the money that you can. Right? But right now, it's interesting. And what I'm about to say, Arthur, I'm going to predicate with an Einstein quote, which is, genius is the ability to hold two opposing thoughts simultaneously. Right? So if I look at the mass liquidity, okay, like just full on conceptually, even if you've got no interest in economics, supply and demand. Normally when there's a mass supply of something, and it greatly exceeds demand, the price falls. So normally, when there is so much money, right, and there's all this cash that's been printed, the real value of that money goes down. That's another way of saying, Michael, inflation. You'd expect inflation, okay? But and a different way of thinking about it would be, when there's mass liquidity gets injected into the market, asset prices go up because everybody has money, so they spend it. So that pushes things up, including asset prices, right? So therefore, the rich get richer. So after the last recession, who made the money? The rich did. The rich-poor divide is wider now than it was, and there's all this money in the marketplace. But here's where the real head, it's too early. I told my team yesterday I won't swear before midday. Here's a real head flip, Alison. Here's what'll screw with your mind. Tell me how this is possible, Alistair. In the last 12 months, if you told me 12 months ago the market was in the toilet, right, the stock market, which is a reflection of the health of the companies, if it's the FTSE 100, the top 100 companies, public companies in the UK, the companies were in the toilet, okay? If you told me in 12 months' time we'd be at record-breaking highs, S&P, etc., we'll be at record-breaking highs, and yet the earnings of those companies that make up the portfolio are down. How the hell, Rob, does that make any kind of sense? The profits of the majority of the companies, people can point to the Amazons and the Apples, but the majority of the companies are down. Fundamentally, the market, the index is down in profit terms, and yet the valuation, the value per share is up. How the hell does that make any kind of sense? Just to be clear, Stephen, I'm not saying that the stock market is a bubble. I'm just saying that the greatest minds in the world, like the greatest investors who I kind of study relentlessly, strongly disagree and have differences of opinion about what to do in most areas. So how do you deal with this mass liquidity? Let me make it much more topical, Emma. If your business has C-bills or bounce backs, Omar, if you've got C-bills or bounce backs, first payments are coming due if you got it at the start, right? The first payment's coming due in the next few months. I've already had a few members say, should I pay the loan back? Because most of our community has been good that you've not had to utilize the money. It's been sat, provisioned, Sonia, Nisha, it's provisioned. Do you pay the loan backs or not? And that is a question that I think you should give careful reflection to. Right? You should give careful reflection to as to what you're going to do. Because if you took that money and invested in something, and the assets that you invested in were a bubble and they popped, you could really be hurt significantly. But inversely, you could say if inflation takes over, the real cost of repaying that loan over time goes down. That's sure as hell what every government in the world's hoping right now. Every government in the world actually basically is saying they want inflation as much as is acceptably possible, because that makes paying off all this debt much cheaper in the future. Right? So now that I've given like a real hodgepodge of a mess, I just don't think I can't congruently give it any other way, because I just think you need to pay attention about what to do. So how do you adapt to this trend? I think you need to have a diversified wealth plan. I really, really think, and this isn't just about tax or about pensions, you really need to be thinking about your wealth. Okay, so as a tiny example, and I'm not saying do this, in fact, I want you to be very explicit, it's not appropriate for everybody. But this is something that I'm interested in right now, and I see an opportunity. And if you've got a profitable business and you pay rent, it may be applicable for you. Retail, commercial properties has gone down in price, and I believe, along with a couple of very significant heavyweight property investors that I rub shoulders with, that the high street will get rejuvenated by a lot of retail being turned into office space. And so, as an example, in Leamington Spa right now, if you look for office space to purchase, it will cost you about £300 a square foot. If you look at empty retail, Georgia, you can find loads that's £150 per square foot. I found one yesterday that was £90 or £87 a square foot. So less than half, almost a third of the price of the equivalent office. And yet planning permission, the councils or the governments change laws, which means you can change of use much more easily. Right? So you're going to see, I believe, you're going to see a lot of offices come up in town centres. But there's an opportunity for investors to buy retail and convert it into offices and get an uplift. Right? Tying it back to the trend number 2, I think residential property investments become much, much less lucrative. It's much harder to drive a return, but I believe the opportunities popped up in commercial to make a significant advantage. And I did an interview. It's actually going to come out on the podcast tomorrow. I did an interview last week with a guy called Richard Davis, who's got one of the biggest HMO property portfolios in the UK. And he bought a building 8 years ago, rented out the other 3 floors, used all the rent to pay off the mortgage at an accelerated rate in 8 years. So he owns the building, but because he bought the building empty, it had a valuation of £1 million, Lisa. So Lisa, you're like this from an asset play. Bought the building, owner-occupied mortgage for £1 million, put 150 grand down as a deposit. In 8 years, he paid off the mortgage because all the other floors are rented out now. The building's got a RICS valuation of 2.5 million. Okay, so he's had a £1.5 million uplift in 8 years. He had it rent free for his company for that 8 years, and the other tenants paid off the rent. Oh, and as an extra bonus, Ian, you like this? The previous tenant owner had never claimed capital allowances, so he got £600,000 worth of capital allowances. So effectively, Jacqueline, he got 100. Let's just call it 120 grand worth of tax relief on his profits in that period of his ownership. So he's got a building that he put 150 grand cash down on. Is now worth 2.5 million quid. He's got no mortgage on the building, and oh, by the way, Alison, there is he's got the net income, the profit from the other tenants of that building is about £200,000 a year. How do you like that for a game, Marcus? So he told me this story, and I'm like, holy crap, let me go and buy some commercial office space, David. Now, I went too deep in that story because that's just something I'm really passionate about now, and that's where I'm always trying to educate myself and learn, and right, and investing to learn, because I think there's significant opportunities. The higher level point, Paul, Chris, is where are the opportunities for you? There is this mass liquidity, and that money is going to get spent, right? As in, the country is going to spend that money. There's more cash on company balance sheets now than there's ever been at any time in human history. I'm not saying inflation is going to go up, albeit I think it's hard for it not to. I'm not saying asset prices are going to go up, albeit I think it'll be hard for them not to. But you need to think very carefully. If, Gavin, you'd liquidated all your stock market investments 12 months ago and panicked and sat in cash, inflation wouldn't have eaten your money away, because inflation's only been about 1.7% the last 12 months. Inflation wouldn't have eaten your money away, but you'd be 30 or 40% worse off than you would have been if you'd stayed excuse me. If you'd stayed invested in the market. Right? And the same's true in your business. So you might be thinking about this, Omar, and saying, okay, yeah, but what does that mean to me? And what does that mean to my company? You've got to think about where your company's going to invest. And I think the bigger your company is, David, the more diversification is probably needed. Right? I don't want to get yourself distracted by shiny pennies, but like the next 12 months is going to be turbulent. There's no way it's just going to be a smooth ride out of this. There's going to be plenty of bumps. Right? What form it takes, who the hell knows? There's massive upside, Laura, but there's also going to be a lot of volatility. Okay? I cannot tell you what to do. If I knew the tactical answers, I would give them to you. But I do think you need to be paying attention and really give consideration to your asset allocation. All right? So, now that I've just basically thrown 3,000 random bits at the wall, I'm going to do the only nice thing to do, which is to throw you in a group to discuss and try and see your way through the mess. Right? We're here to help each other, open your eyes, learn, be open to other opportunities. In fact, I'll ask before I throw it out, because that was very ambiguous, I think appropriately so. But any questions before I put you in, to me, before I put you in breakout rooms to discuss trend number 3, the mass liquidity in the market and what the hell you do about that? I've got 2 pages. I just flip between the pages. All good? All right. Thank you. So yeah, put us in breakout rooms, please. Andy, thank you very much. Right. See you in 10 minutes. Okay, welcome back. Welcome back. Any shares or comments from that third trend where we're talking about the mass liquidity? Any thoughts, comments, musings? Go for it, Georgia.
Thank you. Yeah, there was a little bit of group confusion, I think shared confusion between us. But really the question that I think we all had as a group when it came down to, you know, let's say someone has a spare £50,000 or whatever, and they're looking at how to make that 100,000, is especially in relation to trend 2, are we better off putting that back into our businesses? Or do we do all this other stuff on the side for a bit of extra there? How do we work it?
Good question. And the only answer I can give you that's congruent is I have absolutely no idea. Or let me say it a little bit of a better way. It is case by case, and I'm not trying to avoid answering. Lisa said it quite well earlier. What you should do is relative to your overall capital load and your current position and how exposed you are. Right? If I was to give a principle, 2 principles. One, I would say is whatever your natural inclination, do the opposites. Right? So there's someone in this room that like get excited at every new idea that comes along, and chances are those people are overexposed in certain areas and they need to rein it in. And there are other people, Georgia, who are more conservative, and actually there's opportunity for them, and them staying stuck in cash would be a bad idea. But it's the opposite strategy depending on your starting point. So that's principle number 1. Principle number 2 would be, I think we can all agree Warren Buffett knows what the hell he's talking about. And he's got 2 rules of investing. Rule number 1, don't lose money. And rule number 2 is, of course, refer to rule number 1. So the way that shows up for most investors is asset allocation. In other words, the money spread around a variety of different places. So whilst it doesn't give a beautiful, succinct answer, I think it's a bad idea if a business owner's sole plan for wealth is selling their company one day and that makes up their pension pot. That is probably, I'm not a financial advisor, but that is probably unwise, because all of a sudden they're backing the fact that the business is going to go great and they're going to be able to exit, and they end up in a world of trouble and a world of hurt. And having a pension, having ISAs, having a property portfolio, having being invested in the markets in index funds globally, right, as well as their business, is probably a much wiser idea. I will also say, if anybody's in a panic from an investing point of view, do you know what the biggest single determinant of whether you retire wealthy? Do you know what the biggest single factor is? Anybody want to harbor a guess? It's your savings rate. So in other words, it's less about where it's invested. It's more the fact that you've consciously committed and put money into however you're planning for your investment, for your retirement, right? So I'm less bothered about you eking every other percentage than I am about the fact that you're really thinking and being disciplined about going, you know what? I'm going to pay down my mortgage early, or I'm going to pay more aggressively into my pension, or I'm going to max out ISAs, or, right? It's like, okay, I'm not spending everything I've earned. I'm consciously putting spare capital into assets is the single biggest determinant. And as always, get good advice, be around a peer group like this, but also get good professional advice as well. Does that go in any way? Yeah, I think I got a verbal thank you, even though you're muted. Is that good, Georgia? All right, good. Any other comments, thoughts? I'll flip to page 2. All right, all good. So let me jump back on over. Pièce de la résistance. All right. So here's a thought, right? When I think about the psychological underpinnings of this, right? So we're down at the bottom of the page. The psychological underpinnings of this. I believe, and this is a probably unpopular opinion, but I believe society has become soft and entitled. Every single one of us has heard a business owner bitch and whine and complain because they didn't qualify for the grant. And every single one of us has heard somebody, not necessarily working for us, who has complained that they should be allowed to continue working on furlough. Frankly, I think it's an absolute joke. But this is actually an opportunity for us, because I don't think society has really paid a hard price. I'm not commenting on the medical side of things. There's obviously a lot of unspeakable deaths that have occurred and illnesses, etc. But the fact is, this recession, the government's bailed us out. 10 years ago, the government's bailed all the banks out. Real hard prices in relative terms haven't had to be paid. And I think that that's what's going to amplify this kind of the animosity of the rich-poor divide, right? And a lot of people are becoming very entitled. It's like, oh, well, I should be allowed to stay at home and make 80% of my income. That should just be allowed. And therefore, I think the solution is to become anti-fragile. That is to grow from the chaos. So Anti-Fragile, great book on this topic. The same guy that wrote Black Swan, Nassim Taleb, great book. Anti-Fragile, things that gain from disorder, right? Let me say it a different way, which is somewhat more fun. In fact, I thought I was sharing my screen then, and I wasn't when I was just I was showing you the Amazon page. That's the book, Anti-Fragile, things that gain from disorder. Nassim Taleb. Great book. Good story that goes with that book is about Michael Jordan. So when Michael Jordan, the arguably the greatest basketball player of all time, was at his peak, the opposing team's coaches, Laura, would tell their own team not to physically ruffle Michael up, because you don't want to piss him off. Because what happened when you pissed Michael Jordan off? He played better. He played harder. He turned up the dial. He got stronger, right? So sometimes people are like, oh, let's be robust. Robust is like, I can withstand the shocks. Anti-fragile isn't about being robust. It's about getting stronger from the shocks. And I think that that's the opportunity. When you think about the chaos, and I've just kind of thrown a load of things out about what's going to happen with taxes and what's going to happen with the mass liquidity and inflation and increase in asset prices and the change of tech, right? This could feel very scary and intimidating and overwhelming. But actually, I said earlier in reference to Laura's point about direct mail, you often get better returns in doing the things that other people aren't willing to do. So the fact, Lee, that you're here, the fact, Sonia, that you're digging in, that you're learning, that you're exposing yourself, Jody, to this peer group, Paul, and you're dialing in and you're thinking and you're asking the hard questions. Nobody said it was going to be easy. But that's why not only 0.3, right? So that's 3 in 1,000 business owners in the UK get to 7-figure profits. And yet well above 10% now, and growing percentage of this mastermind group have got 7-figure profits, because we'll do the hard work. That's why you're here. Okay, so that's my thought on the 3 trends. So as a recap, we spoke about the rise of tech, the attacks on the rich, and then we also spoke about mass liquidity. And in reference to what you need to do about it, I think you need to improve from a technological point of view, and you need to work on your customer experience. Tax-wise, I think you need to educate yourself and plan, and Ian, now will be the time to share the video in the chat. And on mass liquidity, I really think you need to give considerations to wealth. I'm doing some work for you in this area. Whether, for those of you that are interested in commercial property, reach out to me. I've got something interesting. If you've got over 200,000 in annual profits and you rent office space, drop me a note. I'll send you a video that I referenced earlier from my friend Richard Davis, and aware that I'm investing, but at a higher level, I'm also going to get some better professional advisors coming in and get a variety of inputs from a wealth planning perspective, Chris, for the future. Right? Become anti-fragile. That's the key takeaway. Emma, Sarah, become anti-fragile. Allow the chaos and the drama and the disruption to make you stronger. Okay, the time is now 11:40. I'm running, I've run slightly long, so we are going to have a brief coffee break. So we're only going to have literally a 10-minute comfort break, and we'll be back back please at a 11:50 for the next session.